Good evening once again. You are watching Investment Academy, and I am your host, Rowena Suarez. And we are now, our discussion today is with Mr. Mark So regarding the foreign exchange market. And so we were just talking about the Asian, the Asian market, right?
So So basically, going back now, if I were to take a loan in Japan, I'll put it into something that will give me more interest.
Yes.
So what if we just look at this very simply? If the Philippine peso or the Philippine government or the central bank is raising interest rates, but Japan is not, what if I just take out Japanese yen, convert it into peso, and then open a time deposit account here? That way, if I'm going to pay the loan in Japanese yen, let's say 0.10% per year, but I'm going to get, even if we get 1% per year,
yeah, it's still a gain.
I'm still making money,
yes,
right?
Yes.
And that doesn't even include the fact that it can appreciate over time. The peso can appreciate more against the yen. And so that's an example of why more and more people are getting away from the yen, meaning to say when they convert it to any other currency or asset, the yen is going to go down, and other currencies are starting to go up. So in terms of Asian currencies, that's basically one of the things that you have to look at.
How do you think this will affect when, they're talking about the Asian integration?
So
How is that?
I've been asked about that a few times, a lot of times by students.
Consider me your student.
Well, my take there is you just look at euro. I mean, if the plan is to have an integrated currency within Asia, it's not going to be a very smooth ride.
I think so.
First of all, if you look at parallels within euro, the euro, which is a currency that is shared by 16 to 18 different countries, are having big problems right now because of the imbalances of the economies of each country.
Exactly.
Germany, which is one of the strongest economies in Europe, is not having a problem. But if you look at other economies, the smaller economies, like Greece, I mean, they can't cope with the high euro. And so, you see, if you take that and put it into Asian setting where you have one single currency, it's going to be a lot of coordination among different governments. And you think that politically that's going to be easy? Of course not.
and I think the politics in Asia is not exactly the easiest thing to...
Exactly. I mean, culture-wise, I mean, Asia is more of a, group hug, right? Compared to Western nations where, it's very individualistic. But even if you have the culture there, learning from the past mistakes of the euro, for example, it's not going to be a very easy or wise, integration. And if ever it does happen, it's probably not going to be in our lifetime, probably not going to be in our children's lifetime, probably 2 or 3 more generations down the line, if ever it
to
does
be
happen.
really ready and for it to be smooth sailing, right?
Correct, yes.
So in investing in Forex, what should we look out for?
Well, in investing in Forex, one thing you have to look out for is scams all the time. I mean, not just Forex, but in investing, right? Scams can come in three ways in the Forex market. So let me say this right now. Number 1, the first scam is through training.
Okay.
I say this as a trainer as well, because you have to look out for people who use their gift of gab to try to part you from your money, and disguised in the fact that disguised in the way that it's premium training. But honestly, what they teach you is something you can download off of YouTube for free. The second way that scams can come in and proliferate is people going to you and telling you they'll manage the money for you. Those are underground money managers. Unlike stockbrokers, but someone who's licensed here who says, who gives you recommendations. The people who get money from you, these are not Forex brokers. These are basically people who were trained 2 weeks, and the trainer told them, you go out, get money, and then every time you trade, whether you win or lose, you get a commission. So that's the second way that people get parted with their money. The third and final way are the brokers themselves. Now, when I talk about brokers, we have to talk about the firm. Like, for example, in stocks, the more, known firms are Citysec Online, BPI, Trade, and so on and so forth, and so on and so forth. We're talking about in the Forex market, brokers, which are firms. Now, I will tell this again, there are no firms registered in the Philippines. And all brokerage firms, legit brokerage firms, are registered elsewhere. There are brokers, and this is where I want you to be very careful of, who claim that they are registered by the SEC and the BSP. But if you look closer, their license is to operate as a money changer. And that's very different from online brokerage, right?
Yeah.
And so that's a third way scams can proliferate. So be careful of those and go to people who know what they're doing.
Okay, so can you share with us like some
Sure.
formula that we
Yeah.
should know before
As a
getting
trainer,
into, as a
that it
trainer?
would be my pleasure. Yeah.
Okay.
So okay, I'm gonna stand up here.
Okay.
And we have prepared a whiteboard. So Forex, let me just write this down, no? Can you see it? Forex basically is trading different kinds of currencies. And so let's talk about the more notable currencies, which is the US dollar. Now, let's take that into consideration with something we all know, the peso, right? So I'm going to put here PHP, which stands for the peso. So if I were to ask anyone here, how much is $1 US? You'll answer,
43.80.
let's say 43 or 44 peso, right? Look at what you did. You just quoted me the dollar in pesos. So the first technical lesson that you want to understand here is to price one currency, you have to price it with a totally different currency. And so how we're going to price the dollar with the peso is this format. The dollar slash the peso equals, let's say, 44.
Okay.
So if we read that properly, it looks like this. $1 equals 44 pesos. So this is the price of the dollar quoted in the peso.
Pesos. Okay.
Now, to make it easier, the first currency here, the dollar, is always known as the base currency, while the second currency here, the peso, is called the counter currency. And if you're talking about a formula, if you're trading any currency, it has to be paired. So if you're talking about a formula again, it looks like a fraction, remember?
Yeah.
So this divided by this is this. So if I were to apply that to foreign currencies now, what will happen is, let's say I put in something foreign like the euro, but this time I'll price it with not the peso but the dollar.
US dollar.
So that will be the format. And let's say I come up with that. So to read it properly, we just say 1 euro equals $1.3. So this is the price of the euro quoted in
US
dollars.
Yeah.
So having said that, this is still the base, that's the counter. And still going with it with the formula of fractions, remember? This and this produce this. Therefore, if a change happens here or here, this changes, right? So the best way to explain this even further, like any grade school person would understand, is the base and the counter have a relationship, and the relationship can be expressed very easily through a seesaw. What happens in a seesaw row? When one side goes up,
Other
side goes down.
Yeah.
And let's put one side, the base, let's say the euro on one side, and then the dollar on the other side. So as a seesaw, they have to balance out, right? And mathematically, they have to balance out. So let's take a look at the price.
So what's 1.3?
If I need $1.30 right now to buy the euro, and then tomorrow it goes to, let's say, 1.4000, then the price of the euro went up, right? But the dollar went down. Why is that? Because I used to be able to buy 1 euro for $1.30.
Yeah.
When it rose, then the euro rose, but I need more dollars now, 10 cents more, to buy the same euro. So when this rose, this went down, right?
Yeah.
Let's do the opposite. What if by tomorrow it goes down to 1.200? So what happened was the price of the euro went down, but the price of the dollar went up.
Yeah.
Because I need less dollars now
To buy 1 euro.
to buy the same euro.
Okay.
So it will always be locked into that kind of relationship. And so
The base and the counter.
the base and the counter. And
Yeah.
so what you have to now understand is, okay, what does this have to do with anything? How do you make money? That's the easier part. Now that you know the relationship, last thing that you want to learn and remember is I want you to imagine 2 cups of water. Dalawang basong tubig, right? I'm going to label this euro. I'm going to label this the dollar. Let's say your money is water and it's in the form of dollars. So I'm going to put money in the dollar cup, right? So what happens is the euro is priced at 1.3. It hasn't happened yet, but I believe it's going to go up, for example, to 1.4. So since that hasn't happened yet, let's draw the arrows. If it goes to 1.4, then this side was going to go up.
Yeah.
This side is going to go down.
Okay.
So if I don't move my money, it's going to lose value. But if I move my money to euro before it goes up, let's do that. I'm going to transfer the money.
Let's say you were able to transfer the money at 1.3.
Yes. Here. At 1.3, I transferred US dollar to euro. Basically, I converted it. So I bought the euro at 1.3 and I sold the the dollar at 1.3. Then my money is now in the euro cup. So what that means is now I'm holding on to euros. What do you do now? This is the hardest part. You pray very hard. You pray that what you did was correct. And so let's say you did the right thing. After a while, it goes to 1.4. Yay. To make money, you basically now have to sell your euros at a higher price. But when you sell your euro, it goes back to the original form. You're going to get dollars back. But look at the water level.
It's higher because
the water level is now higher, which now signifies this was how much dollars I had before. Now I have more dollars now. The difference between the two is what we call your profit. So bottom line, if you want to make money in currencies, all you have to do is you put the money into the currency that's going to go up. And then once it has gone up, put it back to the original currency and you'll have more of the original currency. The difference between the new level and the old level of your original currency is called your profit.
I see. Okay.
That's it.
So, all right, knowing that, with just what you said, how will we know that that's a good currency to buy?
Very good question. The answer there is you need proper analysis. And I don't have the board anymore, but maybe I can just, let me erase this now. Proper analysis, this is permanent. Proper analysis is done using three things, right?
Okay.
Okay, I'll just write it here. First analysis, you need three analyses to know which currency is moving up or down. First is market sentiment analysis. Now, market sentiment is understanding if the market is in the mood to invest or not. Two states, fear or greed. If people are greedy, they're willing to invest. If people are not, then they pull out investments. The second analysis to know is fundamental analysis. And in the world of currency trading, fundamental analysis is understanding economics. So supply and demand, what's happening also with monetary policy and central banks and so on and so forth. That's the second. And the third and final one is, of course, technical analysis, which is now understanding the charts. The market, the forex market is a very technical market. A lot of traders get in, they start with the charts, technical analysis first, but they disregard fundamental and market sentiment. That is a big no-no. You have to start from the top.
That's not the whole picture of it.
It's not the whole picture, correct. And so you have to now start from the top, market sentiment, fundamental analysis, and then technical analysis. That's it.
I see. Okay. So, yeah. So, stay tuned. We will get back into our discussion after the short break.